All right, ladies and gentlemen, we're going to do day 2 investing. So if you answer these questions if you didn't last week, if you answered them last week, then don't do them again. Same with these. If you didn't do them, do them. If you did them, don't do them. Okay, so we're going to talk about the risk tolerance worksheet. Okay, so go around and see if you can find this thing in Canvas or see if you can find it on my website, and answer this question: what is your name? And then we're going to go to right here to this investment website. So click on that, and we're going to go to these questions. So you're going to answer these questions, right? So answer all these questions, and then once you answer the questions, you're going to view the results. And then here's my results. So I'm going to press Control Alt and print screen on the keyboard. Okay, then I'm going to go to my worksheet, and I'm going to click right here, and I'm going to press Control and V and paste those answers in there. Okay, so then once you get that done, you're going to click right here to view the investment. So for me, I have an above average risk tolerance. So I'm going to click here, and so what does that translate to? Probably right in this area. So these are the things that they recommend that I invest in. So what I want you to do is copy those things that they think that you should invest in. Control C, Control Copy, and then you're going to come back to your worksheet. You're going to go to where they have it, and you're going to click. You're going to click here, take a screen. You can do a screenshot, and then also press Control and V, and just take a screen, put the things that you are supposed to invest in according to them. Okay. All right. So if you keep looking at the worksheet, there it goes on to answer 4 and 5, and then we'll skip part 2 for now. We'll come back to part 2 in a little bit. Okay. Okay, so remember this, who's better off and by how much? So Justin invested 12,000 and Michael invested 70. So who do you think is going to be better off? Well, the answer, it depends on who invested first because of the time value of money. Okay, so Justin invested 12,000 from age 22 through 26 and never invested again. Michael, he didn't invest for these first few years, but then he invested 2,000 each year for a lot of time until he invested a total of 70,000. But if you look at what they receive when they're age 62, it's about the same. It's $1 million. And it's because Justin invested early, Michael didn't. So, Justin should have probably kept on investing, and then he would have had $2 million. So the idea is not to continually invest. You should continually invest, but the idea is the earlier the better. So what's the sure way to be a millionaire by age 65? Invest early and continuously in something that gives you a high interest rate. What powerful thing is at work in the previous scenario? I hope you know by now that it's compounding interest. All right, let's watch a video and from Dave Ramsey, and I want you to answer some questions. Here's some of the questions that we're going to answer when this thing is done.
What should you invest in as a young adult? Well, that's a great question. First and foremost, you've got to invest in yourself. And that means taking control of your schedule and building in time for reading and exploring new ideas and even thinking about your future. It means spending time doing the things we're talking about in this class, things like budgeting and finding scholarships if you're heading off to college. It also means spending time working so you can learn the value of money and have the cash on hand to have some fun, buy a car, invest in the future. Investing in yourself is always the best investment you can make. Beyond that, follow the 5 foundations that we've talked about in this class. First, we save up the $500 emergency fund, then get out of debt, and then save money for a car in college, and that takes you to the 5th foundation, which is build wealth and give. For wealth building, I recommend tax-favored retirement plans like a Roth IRA. Now, you can open a Roth IRA even if you're in high school if you have an earned income each year and file a tax return, even if it's just a part-time job. You could also do a 401k if your company offers you one. Beyond that, I recommend that you stick to mutual funds and spread your investments out into 4 kinds of mutual funds: growth, growth and income, aggressive growth, and international. Don't play complicated games with big-time long-term investing. Most millionaires have really simple plans for their investing. They just do the same simple thing over and over again in the long haul. And if you start today, you're going to be blown away by how easy it is to build a pile of wealth that could totally change not only your future, but your whole family tree. Now this bicycle.
Okay, that's enough out of Dave for now. Let's go back to our spiel. Okay, what are the 5 foundations? Write that down. What is a Roth IRA? I'll tell you in a second. And what is a tax-favored mutual fund? See if you can figure it out, but I'll tell you in a second. Okay? Okay, so the five foundations, write this down, it's in red. Get out of debt, save up a $500 emergency fund, save for college and a car, and then finally build wealth. Hopefully you're starting to do all of these things. I really hope you are. What is a Roth IRA? Basically what a Roth IRA is, it's a retirement plan. So let's say you make $1,000, okay, and you put that $1,000 into your Roth IRA. Well, you pay taxes on your $1,000 now, but when that $1,000 grows and grows and grows and grows and grows, and then you pull it out when you retire, and that $1,000 is now worth $20,000, you don't pay taxes on the $20,000. So it's an advantage. You pay a little tax now and no tax later. Okay, what is a tax-favored mutual fund? It's something like this Roth IRA where you're putting it in for retirement and you get a tax savings. Okay, and there's different ones other than the Roth IRA. Okay, what are the 4 kinds of stocks that Dave says you should invest in? Growth and income, aggressive growth, and international. So these are different things, but just kind of keep this in mind. So growth is the company is going to grow in value. So you're going to make your money when you sell the stock. Growth and income is the company is going to grow in value, and you're going to make some money when you sell the stock, but you're also going to get dividends. So every month they give you a little bit of the profit. Aggressive growth is a small company that's growing really fast. It's a little bit more risky, but there's a chance for more reward. And then international is investing in a company that is not American. Okay, what is supply and demand? Hopefully you know this from last week, but the more somebody wants to buy a stock, the higher the value is going to go. And so the more demand, the higher the price. The more the supply of something, the price is going to go down. Okay, so what do you do when the market crashes? So let's say the stock market's terrible. Well, what should you do? Should you panic and sell all your stocks? No, you should buy stocks. The prices are low, so you should buy low, buy when the stock market's low and sell high. The reality is you should buy consistently. You should be buying all the time. But if you had a pile of cash and the stock market crashed, that would be a great time to invest in a lot of stocks. Okay, let's watch some more of this video. All right, listen to this, and we're going to take some more notes on it, so try to pay
You ever
attention.
had a doctor come in and try to tell you what was going on? He sounds like Charlie Brown's teacher. Wah, 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 wah. I had that happen one time. My wife was having headaches, and so we took her in for an MRI, and the doctor comes back out to tell us what's going on, and he comes in and he's like, wah, 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 wah. And I raised my hand, and he said, yes, sir, you. And I said, I have no idea what you just said. And he said, okay. And I said, well, let me try it again this way. Me havey the checky bookie. You want to get paid, you're going to tell us what you just said in English. You know, that guy grew a bedside manner right there in front of us and began to tell us they had no idea what was wrong with my wife's head. I could have told them that for a lot less than $8,000. It's the only sharing joke. We don't do sharing jokes. We're smart. Okay, now. But seriously, I mean, don't sometimes financial people come in, they sound like Charlie Brown's teacher. Wah, 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 wah. Shut up. If you can't speak to me in a way that I can understand what's going on, I am not going to be able to do business with you. This is your phrase. You remember that phrase, and you repeat that phrase for the rest of your life to insurance people, to mutual fund brokers, to estate planners, to real estate people, to mortgage people. Anybody who starts talking to you in another language and you don't get it, don't play it off and act like, well, I'm too dumb and I don't want to, I'm going to sit here and act like I know what's going on and I'm going to sign anyway. And then three years later find out you are neck deep in a stupid mess. Do not put money in something until you can tell me or someone else how it works. You want financial people in your life, but you want ones with the heart of a teacher. And about 85% of the people in the financial industry do not have the heart of a teacher. They have the heart of a salesman. They're there to pitch stuff. And pitch them out the door is what you need to do. You need to get the ones, that 15% that has the heart of a teacher. And they will teach you. You know how they know that? You know how you'll know they have the heart of a teacher? Because you learn. Have you ever seen a movie that has some dull, boring, stuffed shirt corporate zombie droning on and on and on about something? Yeah, I can't stand that guy. But all too often, that's exactly who you'll find sitting behind the desk of an insurance or a financial planning office. And you'll be able to spot them pretty quickly because they'll put their glasses on the end of their nose and they'll look down on you while they explain to you what you should do with your money. You know what I figured out a long time ago? These guys work for me. I'm paying them for their advice. I don't owe them anything. And if they want to treat me like a child, then I'll just fire them and find somebody else. Here's the deal. Your money is your responsibility. You can't just hand it over to someone in a nice suit and expect them to make all the decisions. Whenever you're working with someone, especially in the financial world, you've got to make sure they have the heart of a teacher, not the heart of a salesman. That means they're going to spend time with you actually having conversations about what they think you should do. It means you can ask a million questions and they never seem to get tired of it. It means their job is to load you up with enough information to make your own decisions with your money. And if you don't understand how something works, then you shouldn't buy it. Well, that's true with computers or investments or anything else. Always, always, always work with a pro who has the heart of a teacher. And if you're working with someone who talks down to you and gets impatient with your questions, then you just need to say 2 magic words. You're fired. And that'll shut them up pretty fast, and you can move on and find somebody who's a winner with the heart of a teacher.
Okay, let's keep moving along here. Okay, so let's answer questions. All right, so what's a 401k? It's a retirement plan. You put in some and your employer puts in some. If you have the opportunity for this, do it. Absolutely do it, because it's basically extra money, free money from your employer. So you put in some, but they add in some extra too. So it's really good. So 403b is if you work for a nonprofit company. Let's keep looking. What is Dave's investment strategy in your own words? So what did he just say in that video? Okay, so write that down in your own words. Ready to go? Okay, so here's what I thought. Keep it simple. Invest in things you understand after some research. So I'm teaching a little bit, but you're really going to have to do your own research. Use advisors that you understand, that have the heart of a teacher, not the heart of a salesman. All right, let's watch another video, and we're going to keep on going.
Something could happen to the one place, and we wouldn't want to have that happen. I mean, you know, there could be a disaster, there could be a hurricane, and if we have all of our eggs in one basket, oh, we could run into all kinds of problems. I mean, something could come along and cause problems. This is a regulation 16-pound shot put. Pretty serious. I mean, we could name this 911. We could name this Katrina. We could name it job layoff. We could name it you invested all of your 401k in your company, and your company stock went to zero when your company went broke. So don't buy company stock in your 401k. It's putting all your eggs in one basket. And if you put all your eggs, oh, this is scaring me. Are you guys down there freaking out just a little bit? I mean, there may be a problem here. We may need to get like the plastic out. Are y'all ready? Because if you put all your eggs in one basket, I mean, you know, something could come along, couldn't it? Do we need to draw the suspense out more? I mean, it would be, you want to spread it out. See what diversification does? You see what diversification does? Diversification creates safety, and you're not going to have that happen. Oh! You got to be careful. You got to be careful. You can't bet the farm on one horse, can you? You'd want to spread it out. Because see, if I drop it on that one, or I drop it on that one, I got all the rest of these, and I'll be fine. Everything will be okay, won't it? Now, with virtually all investments, as the risk goes up, you should make a better return. So does the hopeful return. So if I'm going to take less risk, I'm usually going to make less on my money. Does that make sense? Yes. And so there's a spectrum of risk. As I take more risk, I'm going to make more money. I can put my money over here in a simple cookie jar. And I could do an investment in a cookie jar. Now, cookie jars have an interest rate of what? Zero. So I can put my money in here. I'm not going to make anything on it. But it'll pretty much be here. Unless the kids find it. But that's a zero risk, but a zero return. I could take a little bit more risk and put it in a savings account, and I'm going to make like, whoopee, 2% or something, right? But it's going to be there most of the time, as long as I can get the teller to figure out the account number, right? I mean, there's very little risk with FDIC insurance. I could take a little bit more risk and do a CD. I could take a little bit more risk and maybe do a mutual fund. I could maybe buy a single stock. That's even more risk, but I might make more return. I could go to Las Vegas. That'd be a little more risk. Or I could go completely off the risk spectrum and I could be a day trader and lose my tail end. Now, I don't recommend day trading or Vegas as your investment plan, but I also don't recommend cookie jars. Because there's two kinds of risk you've got to consider when you're thinking about investing. Now keep in mind, saving is for 5 years or less. Investing is for 5 years or more. I'm going to leave this alone long term. Now here's the situation. If I lose my money because I put it in a bad investment, that's a risk. The risk of losing my money. And when I say risk, that's what you think of, right? Say yes. Yes. Now, there's another kind of risk though. If you're not making at least 6% on your money when you're investing at 5 years or more, you've got another problem. Inflation and taxes. Because see, inflation runs for the last 70 years, according to the Consumer Price Index, the CPI, that has averaged about 4.2%. And so this $100, if it doesn't earn 4.2%, if it earns 4.2%, it'll just be worth what it was worth last year. It'll only buy what it would buy last year because it's worth 4.2% less in terms of purchasing power. That's what inflation is. Does that make sense? Say yes. Yes. Okay. So I've got to make 4.2% to break even with inflation, and to net, after I pay taxes on my money, making money, to net 4.2%, I've got to make 6%. So 6%, I pay taxes, I break even. So you've got to make 6% on your money to break even with taxes and inflation. And so you've got to move along this risk spectrum enough that you get up in above 6% to be making any real money above taxes and inflation. Does that make sense? Say yes. Yes. So in other words, if I stay back here, I'm not going to probably lose my money, but I'll get tackled from behind by inflation and taxes catching up with me and giving me a shoestring tackle just as I get to the finish line. And all of a sudden I've got a big pile of money, but because it's been over a huge number of years, it really won't buy anything and I'm not ready to go. So you've got to take those two kinds of risks into consideration. Also with investing, when discussing investments, liquidity means availability. When you hear someone say, I have a liquid investment, that just means they can get their money. It doesn't mean they bought water. And so, again, if you take more risk, you make more money. But the other thing is, if you're willing to tie your money up, and you can't get to it, it's not available, it's not liquid, then you can make more money as well. So in other words, it's very liquid in the cookie jar, isn't it? But a crummy investment as a long-term investment. I'm not making anything on it. It's safe and it's liquid, but that doesn't give me what I want for a 5-year or longer investment. Same thing with a stupid savings account or a CD, a certificate of depression. I'm not really making anything on my money after taxes and inflation. So I've got to take a little more risk, and I've got to be willing to tie my money up a little longer. And if I go all the way over here, there's an investment a lot of you have made that is an excellent, excellent investment that is very, very illiquid. It's very hard to get your money out of quick and easy, but it's a great investment, and a lot of you have one. What is it? A house, real estate. Real estate's a great investment, but it's very hard to get your money out of. Your money's not available. It's not liquid. And if you don't believe me, try to sell a house fast. We have a word in real estate for houses that sell fast: cheap. You have to discount the price really deep to get it to move. Proof it's not liquid. Same thing with mutual funds and other things like that. You do not want to be in those things if you have to jump in and out, jump in and out, jump in and out. You want to be able to park your money for a while, and you want to take a little bit of risk. Not too much over to day trading, but we want to take a little bit of risk and be able to leave it alone a little while in order to be able to make more than that 6% and do well. As there is more liquidity, there's typically less return. So as the money's more available, just like as there's less risk, you're not going to make much on your money. So if you want your money available and safe, you're not going to make any money on your money. As a matter of fact, you're probably going to lose money after taxes and inflation. So you got to take a little bit of risk. When you bought a house, you didn't get a guarantee, but it was a good buy, right? Right? Okay. The house is no guarantee, so you took some risk. But it was an educated risk, because real estate has a good track record over many years as being a good investment. So you felt safe buying it. But you don't have a government guarantee against loss on your house, do you? Say no. No. So you took a risk, but it was a reasonable risk for a good investment, and you tied your money up.
All right, here we go. All right, when you diversify, you lower what? As risk goes up, you should make a better what? And what two things make you need to get at least a 6% return? Answer those questions. Okay. What is inflation? Answer these. What is liquidity? And the more liquid, the less what you get. Okay, so let's take a look at this next video. Actually, we're going to skip the next video, but there's just a couple good things from that video I wanted you to know. A money market is basically like a savings account that gets you a little bit more interest, right? And it's good for emergency fund because you can stock up $500, and as you get older, you know that $500 isn't going to cut it. When you get to be my age, you need to have 6 months of your salary, right? So you need something that makes a little bit of interest to keep up with taxes and inflation, but also are liquid. So money market's a good in-between thing where you can get the money, but you make a little interest. A single stock investment should be less than 10% of your retirement. Why? Because single stocks are definitely not the way to diversify. So if you have all your money in one stock, that's not a good idea. So if you do have one stock you really like and you want to invest in one stock as opposed to a mutual fund, just make sure it's less than 10% of your retirement. Okay, so now we're going to watch a little bit of a video.
I'm often telling people, listen, if you invest, you can kind of calculate it based on 12%. The stock market, since its inception, has averaged about 11.8%. And I get these calls and I get this hate mail from these goobers all across America that say, you can't get 12% on your money. You just can't there's no mutual funds out there that get 12%. I mean, I don't know where you have your head stuck, but I tell you what, they're all over the place. There are tons of them. I spent 60 seconds on my Morningstar software just the other day getting ready for this talk. 60 seconds. I found 500 plus mutual funds that have a 15-year track record of 12% or more. I don't think you need 500. You just need a couple of them. So 12% is out there. It's out there. 12% is fairly easy to do. I own one mutual fund that has about just a little bit under a 13% average for over 70 years. And in the last 30 years, it's had 3 times it was down. Now, I don't sell mutual funds. I don't care if you own a mutual fund. It doesn't affect me one thing. But I can tell you this, a lot of our wealth is stored in America's best and brightest companies. Why? Because I think they're going to do well. Why do I think that? Because they've pretty well always done well as a group. Now, I didn't bet the farm on one of those names. I don't know which one of those names is great. And I'm not going to try to figure all that out. But I'm willing to spread it out and be diversified across several. And I even spread it out then across several kinds of mutual funds. You got to remember now, mutual funds are long-term investments. And when you're picking your Roth IRA or your 401k or doing your long-term investing, you need to spread your mutual funds out across 4 types of mutual funds. And you look for a mutual fund that has at least a 5 or a 10-year track record. If the mutual fund is not old enough to be potty trained, don't buy it. If it's brand new, there's no need to buy it. There's plenty of old ones out there. Like that one I said, 70 years old. I bought another one the other day, started in 1958. I bought another one the other day, started in 1972. And these all have long track records. It's like buying a home in a neighborhood where the trees are big. You kind of know what's going on. It's been there a while. You know what I'm saying? There's a track record there that I can count on, that I'm comfortable with. Now, spread your mutual funds investing across 4 areas. Put a fourth of your money in growth stock mutual funds. Sometimes those are called mid-cap funds or equity funds, or you might even see it as an index fund like an S&P 500 in your choices at your 401k or that kind of thing. But put a fourth in those. Mid-cap means this. CAP stands for capitalization. Capitalization means money. So this is a medium-sized company. If it's a middle capitalized company, it's in the middle. It's a medium-sized company. That's the process. Then put a fourth of your money in growth and income. That's the calmest one. It's the calmest one. These are also sometimes called a large cap fund. Cap means capitalization. Now capitalization then means if it's large cap, these are big old dinosaur companies. They don't move real fast. They're not real exciting. They're not going to go up as much when it goes up, but they're not going to go down as much when it goes down. They're kind of boring. And you want this one in here. This is the very precise one. Sometimes these are called blue chip funds because the blue chip on the poker table is the most expensive chip on the poker table. Again, indicating a large company. And so if you hear I've got a blue chip fund, then that's a very calm mutual fund. I put a fourth in aggressive growth. That's the small cap, small companies, exciting, woo, emerging markets. And you don't want to put it all in one of these. Sometimes I hear people say, I'm young, so I'll put all of mine in aggressive growth. That's stupid. If you put all your money in aggressive growth, it's like eating pizza and riding a roller coaster. It'll be fun, but you'll get sick. You don't want to put it all in there because they go way up and they go way down. I had one back in the 90s, made 105% rate of return in 1 year. Lost it all the next year. You don't want to take that ride with all your money, but having a little bit of that flavor in there is good for you when things are happening and doing well. So I have a little bit in there. I have a fourth in there. And then I put a fourth overseas and international, sometimes called an overseas fund, sometimes called an international fund, sometimes called a foreign fund. And you listen for these. Now, it has a kissing cousin called a global fund. I have a global fund that did very well in the last 10 years. Now, a global fund is the whole globe. It's overseas and some U.S., some American companies sprinkled in there. It's everything. And so it's a kissing cousin to the international. And international has no American, but a global has a little bit in there. And they do very, very well sometimes. But that gives you the ability to participate in companies that make products like we named a little bit earlier. So buy with a 5-year or longer track record. Long track record, that's what you're looking for. And spread it across those 4 kinds of mutual funds.
Okay, so take a look. What are the mutual funds that Dave recommends? What are the 4 types of mutual funds? Please give me the name and a description. Write it down. All right, so mid-cap or growth, large cap or growth, and income or blue chips, small cap. Anyway, write down what those are. Go back and watch the video if you need to. Okay, so investment strategies. Here's some ideas. So an IRA is a tax-deferred, pay when you pull out. That's a good idea. A Roth IRA, so pay taxes now, not when you pull it out. So you pay the taxes on the little bit, not on all the growth. So real estate's a good investment, but you need a lot of cash on hand, and you want that to appreciate. So if you buy a house for $100,000, you hope that in 20 years it's worth $200,000 or $300,000. Plus you get rent all along if you're renting it out. And then annuities, kind of avoid them. So one of the things in one of the later videos that they talked about is annuities are kind of like an insurance sort of thing. It's kind of a guaranteed deal. But because of it's guaranteed, it's just you don't make a great rate with them. So typically you want to avoid them. You want to invest in things like a mutual fund where the money's actually going into American stocks or foreign stocks. You're actually buying equity in a company. Okay, so write down, why are these things a bad idea? Why is buying gold a bad idea? Why are buying commodities a bad idea? And why is day trading an idea? And if you don't even know what day trading is, you might want to have to look that up. But answer those questions, why are these bad ideas? Put that in your notes. Okay, so finish up. Turn in the risk tolerance worksheet when you're done with it. Turn in these notes when you're done with them, and then look on Canvas. There's going to be a quiz. I think it might be an old quiz for some of you guys, but do that on the computer instead of on paper. And so here's what I want you to do is do part 2 of the worksheet before you turn it in. So now that you've done all this stuff on investment, so I want you to take a look at one of these things and come up with 3 funds that you're going to use. So copy and paste the information from the first fund, put it there, copy the information from the second fund, and answer the questions in the third fund. So you can, for example, use one fund from here, one from there, or you could find all the funds on the first one. So basically, if you go to this, let's take a look at it, what it's going to look like. Okay, so you have a fund. Here's a federal money market fund. Okay, so what do you think that means? Well, if it's federal, that's probably investing in bonds for the federal government. So so that you might sprinkle some bonds in there. Dave doesn't recommend it, but look through here and see if you can figure out what these things are and what the investment is. And so you can look over here and see what their rate has been. So this one made 0.09% over 5 years. That's terrible. That's a terrible rate. Over 10 years, it's 0.74%. That's a terrible rate. So you want to get to, what's the magic number? It has to be over 6. So you're hoping for 12. So let's see if we can find one that has some good rates. So there's one 5. There's one 7. Ooh, these aren't very good. So you're going to have to find one. Oh, there we go. There's one at 9%. So you're going to have to find some with some. So the last year did 21%. So these are good. So see if you can figure out some of these funds and answer these questions on here. And then, like we said, we want to turn in this worksheet to the basket, turn in your notes, and then take any quizzes that you have online. All right, that's it.